Welcome back, everybody, to the Informed Homebuyer Podcast. My name's Rich Curtis. I'm your host, and I've got my co-host with me, Dave Miller. Good morning, Dave.
Hey, Rich. Good morning. Thanks for having me.
All right, so here we go again, folks. Today, we're talking about a subject I'm very excited to bring to you guys, and that is the VA loan. We're going to be talking about everything VA today. What are the benefits of the VA loan? Who can use it? What are the requirements? What's the process like? Some pros and cons. At the end, we're going to talk about whether, even if you're a veteran, is the VA loan going to be the best choice for you? And for some of you, spoiler alert, the answer is going to be no, and we're going to tell you why and some other things you might want to look into towards the end of the episode today. One of the things I love about the VA loan is that it is a great benefit to our veterans, and I love that we have something to honor our veterans and to promote home ownership for our veterans. I always have been a little frustrated with the fact that it can be a little bit of a tougher loan, so it isn't all of the benefit I wish it was for our veterans, but it's getting better and better every year, and we'll kind of talk about that as we go along as well. But from the top, I think there's some misconceptions about what a VA loan is and who's giving you the money. I think people think this is a loan from the government, and it's not. We're still in the traditional lending landscape. So Dave, can you speak to that a little bit? What role the VA is actually playing in this process?
Yeah, it's a good point, Rich. So the VA, basically, they are guaranteeing the loan or a portion of the loan based on the service member's certificate of eligibility or entitlement. We'll dive into, what some of that stuff means, but basically each loan, and it really follows the service member. It also follows the home. So, you get a certain guarantee as a lender, you get a certain, insurance, so to speak, against that mortgage when you're lending. So as a direct lender, we process, underwrite, fund our own loans. If it's a VA loan, we're following the VA guidelines to ensure that they would insure that loan for the veteran or a portion of that loan.
Gotcha. But when the money is actually coming from Dave works for a direct lender, which is a really great thing. We talk about this a little on the podcast. It gives him sort of total control over the process. He has in-house underwriting. He can move conditions around. He has a lot of control to make the process smoother for people being a direct lender. When someone comes to you and gets a VA loan, the money is actually coming from your company,
That is
SnapFi, not
correct.
the
Yeah.
Veterans Administration.
That is correct. We are funding the loan. So which is,
Yeah.
like you mentioned, all the benefits of being a direct lender. So we process, underwrite, fund loans, whether we end up servicing the loan or not, each loan a little bit different. So it may be sold for servicing down the road. We may service a loan. It just, that's something that, back of the house handles on the servicing side. But that is correct. We will fund that directly and control that process until it funds and records.
I think that's an important distinction because some listing agents, especially if they're newer in the business, haven't been doing this for very long, they might think this is a government loan. We're going through a government system. And as we all know, the government, moves like an aircraft carrier, not a Porsche 911. And so there's some fear that, oh my God, this loan is just going to be a nightmare. We're going to get mired down in all this paperwork and slow moving government bureaucracy type of stuff. But that's not it. You're in the traditional lending landscape. The government is just insuring a portion of the loan such that the lender can take more risk on our veterans and offer to loan them a larger portion of the purchase price, which brings us to our next point. Dave, how much will they actually lend you on a VA loan? This is the primary benefit of the VA loan.
Yeah. And so, Rich, there's a couple, every county has what we call loan limits. And, where we primarily work, 2025, the traditional loan limit, or what we might call a conforming loan limit, is 806,500. So 806,500. Now that is for, what we call the best pricing, the loan limit. What some people don't realize is if you have, and we'll get to this, full entitlement. So as a veteran, if you have not used a VA loan before, you have typically what's called full entitlement. If you have full entitlement, there really is no loan limit. We can go
That's a
above
cool
that.
distinction.
There's no cap. So, you could, where we work, you could have a $1.5 million loan. It does become what we call like a high balance loan, and there'll be some pricing adjustments for that, a little bit more expensive than the 806,500 loan. But again, important to recognize that there is not a loan limit per se for a veteran. And this changed in 2020, I believe.
And now when it comes to that, in case we have some really informed home buyers here who are real techie and they understand that there is a top conforming loan limit, and then you get into the jumbo landscape, jumbo loans, and that raises the rates and all that. is the jumbo loan limit the same for a VA? In other words, you're saying there's not an upper limit of how much we can lend you, but when we shift from sort of regular pricing to more expensive pricing, is that the same limit as it would be on a conventional loan
Yeah, well,
in
yes,
the area?
806 500. So
Okay,
for VA, so as soon as we go above that, it becomes higher pricing, and there is no limit.
and that would be the same though on a conventional loan in our area.
Yeah. So conventional loan, we do once we go above, we have a high balance,
Yeah.
loan limit. So again, and you bring up a really interesting point. So when we do these informed home buyer podcasts, is we're really talking about right now a niche loan, or a unique loan for a veteran, but we vet every individual we talk to. We vet what's the best loan for you. So we always ask a bunch of questions, and we try to determine, are you a veteran? Do you have down payment? Do you not have down payment? So all of everything, every time we work with someone new, we start with the sky, everything's on the table, and we just narrow it down. It's a process of elimination. So
Yeah.
one of the things too is we'll ask someone, are you a veteran? It's
Yeah.
important to find this stuff out. And then, in working with the realtor, where are you looking for the house? What price point? What type of condition of the home? And that's something we'll address a little bit later in this. But, we always want to, I think the VA loan for a veteran is an amazing program. And if you can qualify for it, 100% financing typically is going to be the best option available for you.
Yeah, and that is the major benefit of the VA loan. So in the rest of the lending world, your minimum down payment is going to be about 3%. That's the best we can do in the traditional lending landscape. With the VA loan, they allow you to do 100% financing. So at that point, you now can go zero down payment with essentially no loan limit. The limit is based on what you actually qualify your income, and that you still have to meet those requirements. But there's no cap on how much of a home you can buy with a 100% finance loan. So that is the benefit to you. And we have other podcasts where we go through this, but if you don't even have the money saved up for your closing costs, we can do a VA loan and then ask for a credit back from the seller for closing costs. And for our veterans, you can essentially buy a home with zero money out of pocket. You still have to
That
make sure you're doing your due diligence and staying within your payment coverage zone, but you can have no
right.
money out of pocket.
Right, and for the folks that want to choose to, or in a position where they need to put 0 to no money down, to me, the best benefit of that VA loan is no mortgage insurance. So
Yeah.
there's, now the other caveat is there is a funding fee on VA loans, which is 2.15%, unless you are funding fee exempt. So as a veteran, if you were medically discharged or disably discharged, you're receiving some benefits from the VA. As a direct lender, we have the ability to order what's called your certificate of eligibility, which will tell us whether you are funding fee exempt or not. Most veterans that come to me, that are aware of VA loans, that they typically know whether they are funding fee exempt or not. And Rich, we usually use around a $500,000 purchase price for our market. So if you were to get a VA loan, 500,000, you're paying, a little over 10,000 in a funding fee if you're not funding fee exempt, which you can wrap that into the loan. So we could actually go above 100% financing. So you could wrap that funding fee into the loan. It really only affects your payment, based on current rates, roughly $60 a month, which is going to be far lower on 100% financing than any mortgage insurance program.
Yeah, yeah. And yeah, and if you're 100% disabled, funding fee exempt, then that's another benefit to you. So when Dave's saying we sort of vet your thing, we're asking you, are you a veteran? We're also asking, are you funding fee exempt? Are you a disabled veteran? Have you ever used your VA benefit before? So you have full entitlement. So there's a
Yeah.
whole sort of series of questions Dave's going through to narrow down the absolute best program for you. But those are the two major benefits of the VA loan: 100% financing and no mortgage insurance. And if you're funding fee exempt, the only thing you're paying extra for the VA is that funding fee. So if you're funding fee exempt, it's costing you no more than any other loan program on the planet. So it becomes a very, very advantageous loan to our veterans. And by the way, it's not just for people who don't have the money saved up. It might just be for people who don't want to use the money. Some of our veterans, they're just beginning their post-military careers. They have enough income to qualify for the loan, but they're new in this career and they might not be making as much money as they will be down the line once they've had a few years in the career, and they might just want to keep a little money in the bank as an emergency fund for their family. Some of our disabled veterans have modifications they have to make to the home. There are government programs that will fund some of that, but usually, in my experience, it doesn't fund 100% of it. So if you're having to, do ramps or make the home wheelchair accessible or all kinds of other things, then this saves money to do those kind of modifications as well. So it's not always, I don't have the money. It also is a benefit to those of you who need to use the money for something different, even though you have the savings and technically could spend it.
Yeah, Rich, you bring up a really good point. And for those veterans that are new to the, home shopping market here, or new to the home buying process, or just new into their post-military careers, and they're have stable employment and their income is going to rise. The other benefit of a VA loan is it does allow for higher debt to income ratios than most other loans. So that's another benefit for the VA loan, in terms of, I've seen debt to income ratios through automated get as high as near 60% debt to income ratio. And there's some
Yeah. So in
compensation.
case people don't watch every episode of ours, which they absolutely should, we should have a dedicated fan base who is just dying for the next episode to drop. But in case they haven't seen our other episodes explaining that, give them a brief explanation of sort of front end, back end ratios and what it would be on, say, a conventional loan versus VA, so we can see the benefit there.
Yeah, really good point, Rich. So you have two ratios that lenders are really looking at. Your top ratio, which is just your housing expense, which includes principal, interest, taxes, insurance. And if you have a loan with mortgage insurance, that's your housing expense ratio as a comparison to your gross income. That's your front ratio.
And the maximum on that for a conventional loan typically is?
On the front ratio, they typically like those ratios down in the somewhere in the 30s. 30% range. And then, sometimes they'll go as high as 45. There's always compensating factors. There's credit
but
score.
Average, say like 36 or below is pretty good on a front
that's
ratio.
usually kind of the target for the housing. And then the total debt to income ratio, which is a combination of your housing plus your other debt, usually your other debt that shows up on your credit report, such as minimum monthly payments on credit cards, installment loans, student loans, and there's another portion of the student loan we'll address here. Other debt that you have, that, child support, anything that may show up on your credit report that would add to your total debt ratio. And they will typically go higher debt to income ratio when you have a fair amount of non-housing debt that has the likelihood of going away. Those are things like, student loans or an installment loan. You bought a car 5 years ago, you got, you're 4 years into the payment, or 3.5 years, and you got a high payment. Well, realistically, that payment's going to go away in a short amount of time. So most folks have the ability to get rid of that type of debt as their income. Yep.
So that's your total debt service payment every month to everything going out the door. That comprises your bottom ratio, and they allow larger there. So what are we looking for on a conventional loan bottom ratio usually?
Yep. Conventional loan, you typically 50%, what we'll see on, and every time we talk about ratios, there's two different qualifying ratios for these loans. There's what's called automated. So it's this automated, typically Fannie Mae's DU engine, that will allow for higher ratios than what we call a manual underwrite. As soon as you don't qualify automated, then we have to go to a manual underwrite. You automatically are penalized, unfortunately, and required to have lower ratios. I would say I've been doing this for 20 plus years. 98% of the loans that I do end up getting an automated result, an automated decision, I should say. So, there are some factors that, would contribute to not getting an automated, but for the most part, we will get an automated decision for almost every borrower.
And this is a computer program, folks. Is not AI. Do you think
Yes.
is AI going to eliminate our underwriters? Or are we going to go out of DU and over to iRobot to get our manual underwrites in the near future?
It might make things quicker, but at the end of the day, too, the important thing about the automated underwrite as a lender, myself as a loan officer. Rich, you and I can meet some potential buyers. I can put all that information in myself, uh, gather their income, put it into the system, and get an approval, an automated approval.
And this
But
is in
that's
minutes, really, folks. We're talking within a 15-minute conversation, Dave can gather enough information, plug it in the computer, and within a couple minutes after that, tell
right,
you you're good to go. And we can go
right.
shopping for a house.
That is correct. And what I do, and the other benefit of being a direct lender, is the biggest kind of factor there, and everybody gets paid a little bit different, history on jobs, whatever that may be. I have the ability to have income looked at almost instantaneously or same day within hours from an underwriter. So I know that the information that I'm putting into the automated system is accurate. And there's been multiple times, well, you could deal with folks that maybe don't know how to determine income themselves as a lender. I mean, 9 out of 10 times, I know what I'm doing and I will get it correctly, but I always have that caveat. Hey, this is great. You're approved. Let me get it looked at by an underwriter. So to your AI approach, Rich, as I could say, here's their income. I could, verbally put that all in, probably get an approval, but it's only as good as the stamp that the underwriter gets it and signs off on, with them getting eyes on that income or other factors that are really important that an underwriter sees.
Yeah. We always have people backing up the computer program there. Well, so
Yes.
now we've talked about, so in a conventional loan, we've got ratios, 36/48 is great. 36/50, maybe 40/50 is really pushing it, maxing out in the traditional, conventional loan landscape. What does the VA let us push that to for veterans, top ratio, bottom ratio?
Yeah, so really top ratio usually in the 45 range. And again, it really comes down to the automated and compensating factors. And then up to, I've seen it go, like I said, as high as 60% on, or 59.9 on the bottom ratio, which is
Oh, that's
really
big on the
high.
bottom.
Yeah, because
Yeah.
FHA I've seen go to 55, and get an approval, then or whatever the automated's going to allow. But for VA to go to 60 is pretty nice. Now, the other thing with VA loan, which the other loans, some other loans don't have, is it may not show up on your credit report, but if you have childcare, if you pay for, and again, you maybe send your kids, you're working full time and you have to pay for childcare, there's a childcare worksheet that you have to complete, which would affect your ratios in qualifying. That is separate than the other loans. So just throwing that out there that, when I gather this information, we'll ask, do you pay any, childcare when qualifying for a VA loan?
Gotcha. Child care, not child support. Child support always factors into your debt
Yes,
to
that
income
is
ratio,
correct. Child
but this
care.
is like daycare costs.
Yep, that is correct.
Yeah. Got it. Okay. So we've got the benefits that we can get up to 100% financing. We have essentially no upper loan limits. We don't have mortgage insurance. And if you're disabled, even though there is a funding fee, if you're 100% disabled veteran, you can get the funding fee waived. And we have wider tolerances, wider ratios, so we can qualify a larger number of buyers based on their debt to income perspective via the VA. So that's a lot of benefit all in one package. Let's shift gears and talk a little bit about perceptions in the marketplace, sort of historically and current, and how the inspections and appraisal process are a little more strident and stringent in a VA loan versus a standard loan.
Sure. Yeah, really good point, Rich. So, VAs, a couple things is every VA loan is going to require that that there is clear pest report or clear of active infestation of termites. So we'll talk about that a little bit more. The other thing is the appraisal. The appraisal is done by a VA authorized appraiser. And so you have to be a VA approved appraiser. We order that directly through the VA. They assign the appraiser out, and that's that process there. So it's a little bit unique compared to an FHA or a conventional loan.
And those appraisers look at things a little more stringently and have tighter tolerances for things in a standard loan. Now, this used to be a real big problem. 10 years ago, anytime you had a VA appraiser out, you knew you were going to get hit for mandatory repairs by the seller. And what that did in the marketplace is it created a stigma around the VA loan where it was perceived as a less advantageous offer by a seller and a listing agent than a conventional loan or even an FHA loan, because, oh man, they're going to pick the house apart and they're going to ask me to fix a bunch of things. I'm going to have to spend a bunch of money. Now, and there used to be a whole list of mandatory things the seller would have to fix. Now that's mostly gone away, and it's really down to the pest work, as Dave says. But some of that stigma remains. So when we write an offer on behalf of a veteran with a VA loan attached to it, as a listing agent, when I'm wearing my listing agent hat, of course, this is a buyer's podcast, so most of the time I'm wearing my buyer's agent hat. But if I put my listing agent hat on, I want a cash offer. Cash is king. That's going to be the easiest deal for me. Not that cash buyers are the easiest to deal with. They are by far not. But cash has the least risk, right? Then I want a conventional loan, sort of bread and butter all day long, easy loan, preferably a 20% down conventional loan. Great. This person's got money. They got skin in the game. I feel secure with this. Next, I want an FHA loan. And then below that, it was, VA and, some of the other, wild, USDA programs and things like that down the bottom. I would say now VA has kind of come up a level to where FHA, VA, it's the same. They both have a slightly more stringent appraisal process, but nothing that's too crazy anymore. But you have to have a buyer's agent on your behalf who's going to advocate and make that case, and a lender who will also call that listing agent, make that case, and educate the listing agent in case they're older and been doing this a while and been burned a couple times on an old VA loan, and they're like, I don't want to deal with it. You got to have someone who says, look, it's not like that anymore. Let me show you, how we get around all this stuff. And to be fair, I had said, in fact, on a recent podcast, if you watch it, I said I hadn't had a VA call out in like 10 years. We're doing a VA loan right now on behalf of one of you, a YouTube buyer. Thank you, YouTube, for coming out and supporting the business. And we did get a call out, and it was for like some peeling paint on the deck and some peeling paint on the trim, something that the homeowner can stand down and paint themselves. It wasn't a massive financial problem, wasn't a big deal in the transaction, but we did get a little call out there that probably we wouldn't have gotten from a conventional appraiser. So those are some of the little nuances to this that we face in the transaction process itself.
Right. And those call outs, Rich, those typically just require a reinspection from the appraiser just to make sure those things are done.
Yeah.
The little added cost to that, I want to say it's, average $150 for the appraiser to go back out there, snap a couple photos and upload them to the report.
Yeah, exactly. And when it comes to the pest report, Dave was saying most of the time they'll require no active infestation. So if a full pest report shows active infestation, we have to give the full pest report to the VA and the lender, and they will likely require a Section 1 pest clearance, which will mean not just solving the active pest infestations, but also clearing all the dry rot and anything else the report lists. If the home is free of any active infestation or pests, then you can go ahead and use an alternate form. Did I get this right, Dave? NPMA 33?
Yep, NPMA 33, that is correct.
And the lender will allow that form and require no repairs at that point. Is that right?
Yeah, they will take that in lieu of the pest report. So in that report states, and it needs to be signed by, licensed, home inspector, pest inspector, acknowledging that there is no active infestation on the property.
Yeah, and this is state specific, by the way. So that is something that works here in California. In other states, the pest inspector can use that form alone and not the standard form. In California, pest inspector still has to issue the legally mandated form. However, if that form shows no active pest infestation, they can issue this alternate form to the VA. So there is this stigma in the marketplace that VA means pest clearance no matter what. And that is not actually the case. We don't always have to pursue a full Section 1 pest clearance on a VA loan, provided there's no active infestation. Now, one nuance, Dave, when it comes to Section 1 and Section 2 work, if there is active infestation and we've turned over a full report and the VA is required a clearance, do they only require Section 1 or do they often require full Section 1 and Section 2 clearance?
It just varies on where the Section 2 is. Oftentimes, up to a little bit of underwriter discretion there as well. So it's always going to be a little bit different, but especially if it's part of the home and it's an issue that has a high likelihood of continuing to be problematic or spread, so to speak, they will require it to be addressed.
Gotcha. Yeah.
Yes.
So quick education on pest reports are broken up into three parts. Section 1 is any active infestation or dry rot problems right now. Section 2 is anything that could lead to a problem, like
Mhm.
dirt pushed up against wood will eventually rot it. A plumbing leak dripping onto wood will eventually rot the wood, things like that.
Right.
Section 3 is inaccessible areas. We couldn't see it. We don't know. So what Dave's saying is there is a potential, depending on the nature of the Section 2 work, that the VA may call that out. And ask for that too. In the marketplace, this varies. It's a point of negotiation. It's often a viable option to ask the seller to clear Section 1 pest work or credit for Section 1 pest work. It's much more rare that we get any kind of credit out of a seller for Section 2 work. So that is another nuance to the VA. If you do have active infestation, you turn over a full report, you may get into a little bit of not just Section 1, but some Section 2 as well.
That is correct. Yep.
All right. So who should use the VA loan and what are their qualifications? So obviously the first qualification is that you are a veteran who has served in the US military, Dave. Beyond veteran status, what are the income requirements? We talked about the debt to income ratios and those are
Yep.
wider. Any other requirements? You got to be a veteran. You got to fall within those debt to income, which you said, top ratio 45, bottom ratio up to 60. Those are
Yeah.
great.
Yep.
What are our minimum income, minimum credit score requirements, that sort of thing?
Yeah, so, no minimum income requirements. It's got to be enough to based on the purchase price that you're paying and what your debt to income ratio. Credit score typically 620 again is that kind of magic number. It will go lower. There are some pricing hits for that. Once you go
When we say
beyond
pricing hits, that means higher interest rate or
higher
fees you
interest
have
rate.
to pay.
That is
Yeah.
correct. Yep. That is correct. And again, so with the VA loan, as you mentioned, starting out, they typically have lower interest rates than a conventional and or FHA loan. All loans are a little bit dependent on credit score. And you also have the ability to buy down your interest rate or pay points to get a lower interest rate. So one other thing that, and I don't know, we'll get there yet, the benefits is going to be, seller credits that will offset some of that. We'll talk about that in just a second. But to finish your other question, income, if you have a co-borrower for a VA loan, in order to use their income and use them on the loan, need to be a spouse, married. So
So a
that's really
non-occupant co-borrower
no,
who's
no,
not a
no
spouse.
non-occupant. You got to be living in the house. There's no non-occupant co-borrowers.
Interesting.
But as a co-borrower, to utilize and to qualify needs to be a spouse.
Yeah. I mean, to be fair, folks, to put in perspective how much of an issue this is, last year, Dave and I did a non-occupant co-borrower loan, and I think it was the only one I can remember ever doing in 20 years in this. But it's not something that comes up a ton that we use non-occupant co-borrowers. And in fact, oftentimes when we start going down that rabbit hole, the non-occupant co-borrower isn't of that much value. It doesn't help. It's not solving the problems we need it to solve. So the fact that the VA excludes this option really is going to affect a very minimal amount of people in the buyer pool.
Yeah, that is correct. Yeah.
Okay, so the requirements really are just that you're a veteran and
Yeah.
to get the best pricing 620 or above.
Right. Yep. And you have some entitlement left, whether it's full entitlement or partial entitlement. And that's a whole separate conversation. You have a partial entitlement, then we got to do what's called a max mortgage worksheet and figure out what loan amount you can get to. And if once we do that worksheet and you get to a certain loan amount, you always have the ability, let's just say you were buying a $600,000 house, but your max loan amount based on the worksheet says your max eligibility is going to be 580. Well, you got to put $20,000 down. That still may be more beneficial doing the VA loan and putting some money down if that's what's going to allow you to qualify. So
Gotcha. And the only thing that affects that full entitlement is whether you've done a VA loan in the past or not.
yes, now you bring up a really good point, and I've done this a lot where I have someone that did a VA loan. They sold their house, and the VA don't want to offend anyone, doesn't necessarily move real fast, right? But let's just say someone sold their home rich, a month ago, they come to you, they're relocating, whatever it may be, they want to do another VA loan. I can get and fast track their entitlement to be reestablished. by providing the final settlement statement for the house that they sold, get that over to the VA, fast track that full entitlement. Now, there are times, and again, this is rare, you could have a VA loan and then buy another home with a VA loan, but you're not going to have full entitlement. It's kind of
Gotcha.
rare based on the loan limits we're talking about that you're going to get a 5 or 6 or $700,000 loan if you've already used your entitlement.
Gotcha. But
Or
if you've used your entitlement and then you sell the home, you are due full
yes,
entitlement again. It's
that
the
is
only thing that
correct.
affects your entitlement would be an attempt to carry more than one VA loan at one time.
Or if you did foreclose or short sale on a home. Um,
Ah,
yes. So, you may have jeopardized some of your entitlement at that point. But again, that's where that, max mortgage worksheet comes into play. And typically we're going to be fine, but it's a case by case basis. So we ask all the questions just to know up front.
but if we're a normal bread and butter veteran buyer, we've never owned a home before, we've never foreclosed on, then we can assume we've got full entitlement.
Full entitlement. That is correct. Yep.
Awesome. And
Yep.
if you don't fall into that category, again, guys, this is where getting sort of nuanced personal advice and not trying to muddle through this on your own and using online calculators and all that business. If you want to know more about that, we have a whole podcast on online calculators and how to do those right. But this is where just calling up your trusted lender. If you're in our market, we'd love to chat with you. You can call Dave and he can go through your personal situation with you. Have you owned a home before? Have you used a VA loan before? Have you ever been foreclosed on? Are you disabled? He just goes through all those questions with you and he can give you answers tailored directly to you because we try to give you the simplest, most digestible version of these things on the podcast to help you get familiar with it. But it really, there are a lot of nuances and there are a lot of things that each person's specific case is different as to whether this will be the best product for you or not, which I think is a good segue into talking about, Dave, some of the veterans that come to us and we, pardon the word association, we vet them through the whole process of whether VA is right for them. And we come to a conclusion that actually there's a more beneficial program given your situation. Let's talk about that avatar, what buyer with what income situation we might say, you know what, buddy, conventional is going to be better for your family,
Right. Well, it also comes down to like you said, what's your short-term and long-term goals? And so I've had folks come to me wanting to do a VA loan now. Maybe they want to own multiple homes over time. They have some money for down payment now. They qualify conventional. So or FHA. And so we may say, hey, let's go with this program now because once you own a home, and then you want to buy another home down the road, then you could use your VA and you will have higher ratio limits or thresholds. So you'll be able to, have multiple mortgages at that point in time. So there's every potential buyer is unique and what's their short-term and long-term goals and why would we put you in another program even if you do qualify for VA at that particular point in time, or if you're putting a bunch of money down and we look at rates and we compare rates. It still may be advantageous to do a VA loan, but sometimes we'll look at what are those pitfalls, or if you're not fully funding fee exempt and you have a slightly higher interest rate conventional, but by the time we do the math and back into it, it's not worth paying the funding fee and going VA. So all these little things come into play.
Man, that's such a good point. And this is why it is so important to have a full team working on your behalf to make a real estate purchase. When Dave says something, I've been in this business 20 years, and when Dave says something like that, and it sinks into me the point he's just making, I go, damn, I wouldn't have thought that through in that way for that client. And that's the value of having a full team. So let's put a pin in the point he just made, which is, what if you have someone coming to us who's going to play Monopoly? And I'll give you an avatar of who this person might look like. Nurses a lot. In our area, we have UC Davis Med Center down in East Sacramento, Tahoe Park, Elmhurst. These are incredible rental neighborhoods. Oftentimes we get nurses who come into town. They want to have a home. They're going to buy right now. They know their income's going to go up. They're going to have a boatload of overtime. This is, once you get into that UC Davis Med Center system, it's a very upwardly mobile environment for these people. Maybe they buy, they're veteran and but they're telling us, I want to buy the bigger, better, badder home a couple years from now. And so you're saying, well, but I want to rent this one out. I'm going to start using my income to build my little real estate empire. And then you say, well, wait a second. The VA loan provides for you wider debt to income ratio than does these other loans. So buy your cheaper starter rental house with a regular loan, preserving your full entitlement. And then when you come back to us and we have to qualify you for the loan for the bigger, badder house and still have your previous mortgage counting against your debt to income ratio, we now have a wider debt to income ratio to work with. That kind of advice and insight is invaluable. It doesn't matter how much you're paying the person who gives you that level of insight. That could be the difference between you making your monopoly plan work and not work, and utilizing this extra advantage of the VA loan. That was, I think we kind of cruised through that pretty quickly, but that's a really incredible point that we just made. So I want to put a pin in that one for
Right,
everybody.
and I think to that point, Rich, too, is sometimes and back in the day, and we never gonna predict where the housing market's gonna be a couple years down the road or someone's ability to refinance. But I've also seen it where someone does a VA, 100% financing, they gain 20% equity just through market appreciation. They know they're gonna buy another home. Let's refinance that out of VA right now, use the equity as your 20% down, so to speak, go to from VA to conventional. Now you have a conventional loan, and then when you're ready to go buy your next bigger, badder home, and you're ready to go VA, you have that route as well. So we just look at all this stuff and explain what options are, but never say this is how it's going to happen and you are guaranteed to be able to do that. We just don't make
Right.
that prediction.
Well, and that's a situation where you getting on the horn and trying to fast track the return to 100% entitlement might come into
Yes.
play.
Right.
You know,
100%. Yep. Yep.
because we're keeping this home. We just
Yep.
satisfied or paid off the VA loan, but now we need that entitlement back so you can rent this
Yep.
one out and go get your other one.
Yeah, and the other benefit with a VA loan too, which in that same exact scenario is VA offers what it's called an EARL. So it's an interest rate reduction loan, and the qualifying for it's pretty nominal. You just have to reach certain milestones and lower your interest rate a certain amount, but then you don't have to re-qualify for that mortgage. We don't have to get another appraisal. So you have the ability, if rates drop, to do a refinance on that VA loan. But that's where I say, hey, before we do that, what are your plans? You've built all
Yeah.
this equity. You might want to consider doing conventional on this if rates are similar or whatever that situation. And so those are the types of scenarios that we talk through, and we don't want to limit someone's options.
Yeah, and that's why I tell my clients all the time. Once we close your transaction, your first transaction, we're not breaking up. We're not
Mhm.
going away. We're your advisors for life. When you're going to refi, call. I think oftentimes people will work with a lender or a realtor, and they'll have a really great experience, but then maybe we don't keep in touch as good as we should. That's on us. Or they just don't remember. And it comes refi time, and they got something in the mail, or they got a call from their bank, and they're just walking their way down a canned process with an hourly 800 number worker at the bank to do this refi that's not giving this nuanced advice. And they forget that, hold on, I have a professional advisor who's been doing this for 20 years that I can get on the phone and call and just ask questions. There's no cost for asking questions. Our phone numbers are in the description. You can call us today and get free advice. That's what we're here for. So avail yourself of that option. Get the best advice you can before you make any moves when it comes to your real estate and your loans, even after the purchase date.
Yep, very good point.
So when it comes to that buyer that might not choose VA, like Dave said, well, maybe if you have 20% down and you're not funding fee exempt, then you might be looking at this and say, well, nah, conventional's better. You're not going to have the mortgage insurance. So the VA not doing mortgage insurance isn't a benefit. The VA does start at slightly lower rates, but you're going to compare that rate against the cost of the funding fee and how many years until you likely refi. And we can kind of walk you through those calculations. And for a percentage, and it's not an insignificant number, people who come to us saying, I'm a veteran, I want to do my VA loan. And when we vet their full picture, it doesn't make sense. Let's do something else. So the other thing I would say to our veterans watching is, just because you're a veteran, don't assume the VA is your best option. Get some professional, specific, nuanced advice for your case to truly make sure you're getting the best loan for you and your family, because these decisions have consequences. And if you stay in that home a long time, they have long-ranging, decades worth of consequences. You want to make sure you're starting out in the best possible position on this.
Yeah, and one other point to that, Rich, and I don't want anyone to assume make the assumption that it's important or not, but I make the same whatever loan type you do. I'm not going to
Right.
be motivated, and I think just like you as an agent, Rich, is we want what's best for you as the consumer
Yeah.
always. I always, want to represent what's in your best interest. And I am not motivated to put you in one program or the other from a financial standpoint. The other point to that too is some people are motivated to put in a specific loan program because they understand it better.
Yeah.
And that's, in terms of speaking with different mortgage professionals or different folks out there, or even different lenders, or excuse me, different realtors, is, you brought up the point, Rich, that years ago, a VA loan had such negative stigma that oftentimes, a realtor or a listing agent may not even want to, oh, you're going to submit a VA offer. Don't even submit the offer. I don't want to bring that to my sellers. Well, Rich, as a listing agent or a buyer, how to have a conversation with that listing agent or
Yeah.
with that buyer's agent and let them know that, okay, oh, you're VA. Let's talk through what any of the pitfalls are. If we check the boxes, perfectly happy with it. But it's
Yeah.
it's really important to understand and be knowledgeable about the programs.
Yeah, and it's such a good point too that you can get really bad advice in this industry from people who aren't well versed in all the programs. So if you come to a realtor and you say, "I want to do my VA loan," and they're going to refer you to a lender, you might get a realtor that says, "Man, that's just going to be so hard to get you a house with it. You should really do conventional." And that's because they have these old ideas, old stigmas, or they haven't done the research. They don't know anything about VA loan. They're comfortable in this sort of bread and butter. So you have to really watch out for bad real estate advice. To that end, we drop 2 videos a week on this channel. We have the podcast with Dave and I every Wednesday or Thursday. And then we have a video that drops on Saturdays. This week's is 10 of the worst real estate advice you could get that I've seen in the last 20 years, why it's bad, why it's wrong, and how to avoid that. And avoiding your VA benefit because it may have a stigma in the marketplace is actually one I should have included in that list that I didn't, but that is bad real estate advice. You should get all of it. We talked about ratios here. There are people out there, Dave Ramsey, big financial guru. If you want to learn how to get out of debt, listen to everything Dave Ramsey has to say. He's great at getting people out of debt. His books will change your life. He also says that your top ratio should be 25%, that your mortgage payment shouldn't be more than 25% of your take-home pay, which if we were to get in our DeLorean and fire up the flux capacitor and go back to 1952, that would work, Dave. But today, that's nobody could buy a house. Average American makes $65,000 a year. You're talking about mortgage payment about $1,200 a month by Ramsey's calculations there, and you're talking about $120,000 purchase price. Maybe somewhere in the country where you're coming from that works. It doesn't work in California. So that's a great point about just bad advice because people aren't comfortable with the program. So don't listen to anybody who says you should not first vet your VA benefit. If you are a veteran, the first loan you should be having a discussion about is your VA loan. And from there, if it's not the right fit, we'll tell you. But that should be the first line of attack. That should be the first road we're going down for you as a client. If you have that benefit, let's get every bit out of it we can for you. Don't let anybody tell you different. All right, we'll jump off our soapbox now. I think we'll wrap there. I think the upshot for me is I love the VA loan. I love that it is a benefit to our veterans. I love that it gives us more flexibility to make homeownership more affordable for more people. I wish, and I doubt anybody from the VA is watching my podcast, but I wish it was even easier and even better. And as an industry, I think we should push for that. But for now, don't let anybody tell you this isn't a great option for you as a veteran. Get on the phone with an experienced lender and realtor who have done these, who know how they work, so you can get all the benefits you deserve for serving our country.
Yep. Well said.
All right. Well, Dave, as always, thanks so much for coming and dropping so much knowledge on people today. I really appreciate it. For all of you, I hope you got a lot out of this. We are 43 minutes and 53 seconds in, and you have been listening to 2 middle-aged men prattle on about economics and real estate. If you're doing that, you are either a sadist or you are deeply committed to your own financial education. And if that's the case, either way, we appreciate it. Thanks for getting to the end with us. Thanks for coming out for the podcast, and we will see you all on the next one.
Thanks.